Hi everybody, this is Lara with your weekly video for the S&P 500 for the week ending Friday 5th of August 2022. Again, now that we've completed the month of July, it's time to step back and look at monthly charts. For the bigger picture, I still expect a primary degree second wave is going to complete to a target at 3195 or thereabouts before a third wave up should then begin. Overall, I still expect that the secular bull market will continue after this bearish movement is done, and I'm looking for an end to the bull market in either March or October 2029 for a cycle degree fifth wave to end structures at super cycle and possibly grand super cycle degree. I do still have an alternate wave count which considers the bear market over. It is still considered to have a lower probability, particularly in light of Lowry's analysis, expecting that sellers had not capitulated at the low. Elliott Wave analysis first, classic analysis last. The monthly chart level, this is the end of the global financial crisis. This is March 2009. This is where the global financial crisis found a low and this bull market, which has lasted over 10 years, began. I am labelling it Super Cycle Wave 5. So Super Cycle 4 ends, it was a huge expanded flat, and Super Cycle 5 begins. If this wave count is correct, this is Super Cycle 5 to end Grand Super Cycle 1. Elliott Wave is fractal. You have to fit the monthly chart into the quarterly chart picture, and at the start of every analysis I link you back to the Grand Super Cycle analysis. This upcoming trend change, when it happens, is expected to be absolutely huge, but I do not expect the structure is complete yet. Let's look now at the structure of Super Cycle 5. I'm labelling it Cycle 1, short, not extended. Cycle 2, a zigzag lasting 5 months. Cycle 3, a long extension. It exhibits a Fibonacci ratio to Cycle 1. It is 39.38 points less than 2.618, the length of Cycle Wave 1. Cycle 4, an expanded flat, a 0.4 correction of Cycle 3 lasting 18 months. There isn't great proportion between 4 and 2, but overall you still want to see at least this and this as of equivalent degrees. And that's okay, the S&P doesn't actually always exhibit great proportion. The structure within Cycle 3 has a really good fit. Primary 1, 2, 3, 4 and 5. Primary 4 was a triangle and Primary 2 a combination. So there's alternation within there as well. If Cycle 4 ends here, and this is March 2020, then Cycle Wave 5 should have begun here. So this is the beginning of the pandemic. Cycle Wave 5 may only subdivide as a 5-wave impulse. I do not want to label it over here because there is not enough support from classic technical analysis for Cycle 5 to be over here, because I would then be calling for a trend change at cycle and super cycle and grand super cycle degree. Only when technical analysis aligns up, specifically the AD, NYSE All Issues line and Lowry's OCO AD line and the NASDAQ AD line, specifically when they all have a long enough bearish divergence at a high, then I will be looking for a trend change at a huge degree. This is not it, according to that analysis. And so I expect Cycle Wave 5 may be extending, and Primary 1 may be over, and now I'm looking for Primary 2 to find its low, most likely subdividing as a zigzag. Primary 2 may not move beyond the start of 1, below 2191.86. This wave count considers that at the end of this bear market, the global pandemic began, and Cycle Wave 5 lasting through the 2020s may mirror the 1920s. The 1920s found the end of a bull market in October 1929. I'll be looking for possibly the end of this bull market in October 2029 or maybe March 2029 if the 2020s mirror the 1920s. They were both fifth waves, and I expect that the exuberance and extreme hedonistic behaviour that we saw in the 1920s, we might also see in the 2020s following the global pandemic of 1918 and the global pandemic beginning in 2019. Let's take a look at the weekly chart from this low here, the start of Cycle 5, this point down here. Primary Wave 1 fits beautifully as a 5-wave impulse with intermediate 1 extended, 2 a zigzag, 3 a longer extension, 4 and 5 quite short. So within primary wave 1, it is intermediate waves 1 and 3 which are extended, particularly intermediate wave 3, a long drawn out extension. That's very common for the S&P 500. If primary wave 1 was over here, then primary 2 should unfold as a corrective structure, most likely a zigzag. Within it, intermediate A may be over at this low with minor 1, 2, 3, 4 and 5, a 5-wave impulse. Now looking for minor wave B to bounce higher to complete a counter trend movement before minor wave C may begin. Intermediate B, not minor B. When I have confidence that we know where intermediate B may have ended, then I can add to the target calculation for C at intermediate degree. At that stage, the expectation for the target at 3195.28 may widen to a small zone, or it may change. Within the zigzag of primary 2, intermediate B may not move beyond the start of A above 4818.62, and primary 2 may not move beyond the start of 1 below 2191.86. When this bear market is over, this wave count will be expecting a third wave up at primary degree. The next move up for this wave count should exhibit an increase in strength and possibly even volume, although not necessarily, and I'll explain why when we get to the technical analysis monthly chart. At the daily chart level, we're looking at the detail now of primary wave 2. Minor 1, minor 2 an expanded flat, minor 3 extended, minor 4 a more brief expanded flat. There is not good alternation between minor 2 and minor 4, they're both expanded flats. That's okay, alternation is a guideline, not a rule. This wave count has a good fit. And minor wave 5, an impulse. Intermediate A, a complete 5-wave impulse, and now intermediate B looks like it may be unfolding as a zigzag, with minor A and B complete and minor C extending. The target is for minor C to reach 1.618, the length of minor A at 4219. Within minor C, I have minute 1, 2, 3 and 4 complete. Minute 4 moved sideways this week as a triangle, and so checking at lower time frames, minute 3 is shorter than minute wave 1. So adding minute 5 to the start, or the length of minute 3 to the start of 5, gives us a limit, because within minor C, minute wave 3 may not be the shortest out of 1, 3 and 5. That's a core Elliott Wave rule. That tells you that when the third wave is shorter than the first, your fifth wave has a limit of no longer than equality in length with the third. In this instance, the limit is calculated at 4345.63, and the target is below that point. So I don't expect minor B, if this part of the wave count is correct, to reach up to the 0.618 Fibonacci ratio of, intermediate B, to reach the 0.618 Fibonacci ratio of intermediate A, because that's above the limit now. At the weekly chart level, this wave count is the same to this point here, and now I'm considering a different structure for primary wave 2. Primary wave 2 may be any corrective structure except a triangle, so it's important to consider alternates when price is in a corrective position. Primary 2 could be continuing as a double zigzag, W, X, Y. The problem now is B is very high in relation to A. If it's over, it really should have been over a couple of weeks ago in order for intermediate Y to have a really normal look. Double zigzag should have a strong counter trend slope, and the depth of B in relation to A is a little bit unusual for a zigzag, although it's well within allowable limits, or within the rules. But for intermediate Y to have a strong counter trend slope, B shouldn't be looking that deep, so the probability of this wave count's reduced, doesn't quite have the right look. B may not move beyond the start of A above 4176.90. At the daily chart level, we're looking at the detail of this alternate. Intermediate W, the first zigzag in the double. Intermediate X, a 3 joining the 2 in the opposite, 2 zigzags in a double in the opposite direction. Intermediate Y, an incomplete zigzag. A, B and C to move lower. B may not move beyond the start of A above 4176.90. And this is the second alternate wave count. It's published in the spirit of considering what if I've just got it wrong, what if Lowry's bearishness is also wrong, what if the bear market was over here and the bull market is on a new stage, what if primary 2 is over and primary 3 is in its very early stages. For the start of a third wave at primary degree, we should really be seeing more strength, and I would expect primary 2 to end with a V bottom and the start of a primary degree third wave to have a nice strong V bottom look. That's not what this looks like, but it's important to consider these kinds of alternates. I want to see a new high above 4818.62 before I'd have reasonable confidence in this wave count. If primary 2 is over here, it will fit as a double zigzag WXY. If primary 3 is underway, a reasonable target would be for it to reach equality in length with the long extended primary 1 at 6264. If that target is wrong, it won't be high enough. The next target would be for primary 3 to reach 1.618, the length of 1. Once I have confidence that primary 2 is over, I will then start to calculate those higher targets for you. I just think it's premature at this point. Within primary 3, intermediate 2 to come may not move beyond the start of intermediate 1, below 3636.94. Okay, let's step back and have a look at the monthly chart. The first thing to note on this monthly chart, as I keep noticing, is as we see this bull market continue higher, we see volume decline. As this fits within the larger picture of a supercycle degree fifth wave, this could make sense. Declining volume as the supercycle degree fifth wave comes to an end could fit, particularly for the end of a grand supercycle degree first wave. We've repeatedly seen price moving higher on light and declining volume. For this movement, and this movement after the March 2020 low. That just keeps on happening. And now for the short term, price is falling in this correction or this bear market, and volume is also now declining. This supports the view that this bear market could be over sooner rather than later. Volume is not pushing price lower as it normally tends to within the S&P 500's bear markets at this point. At this high, there was some good long-term bearish divergence between price and RSI. No signal from on-balance volume. RSI is back in neutral territory and ADX is declining, indicating no clear trend. ATR increasing as price moves lower within this bear market is absolutely normal behaviour. At the weekly chart level, the last completed week shows a lack of volume and smaller range as price is finding resistance about 4160, 4170, a little bit of a range there, and I've got different figures I know on the weekly and daily chart. There's a little bit of a range. It looks like upward movement is getting a little bit weaker in this last completed week as it hits resistance. This tells us again that I would expect this bounce to be over probably sooner rather than later now. No new signal from on-balance volume this week. This weak bullish signal was probably now resolved by some upward movement. RSI in neutral territory. It has not reached oversold at this low and there's no bullish candlestick reversal pattern. Money flow index also in neutral territory. No bullish divergence at the low either. ADX declining after indicating the downward trend just reached extreme. At this point it's indicating no clear trend. Stochastics neutral and ATR now flattening off as price moves higher. At the daily chart level, prices moved pretty much mostly sideways in a small range for the week, slightly higher, resistance 4160 to 4170. Upward movement is slowing. Volume is declining as price is starting to move a little bit more slowly. Absolutely normal behaviour as the S&P comes to find a high. On balance volume gave us a strong bullish signal as it broke above this long held, often tested resistance line, coming down to test support now. This may assist to halt a fall in price. We may see a bounce up from here, but there's still resistance to overcome. ADX indicating at the at the daily level there is an upward trend in place, and RSI is not overbought, nor is money flow index, and ADX is not extreme. There's room for this upward trend at the daily chart level to continue. Stochastics overbought, but when this market trends at this time frame, that can remain so for a long period of time, and ATR declining as price moves higher is absolutely normal behaviour for a bull market, for this market. Looking at breadth and volatility now to round out the picture. Upward movement this week has failed to close to a new high beyond this prior point. The AD line has made another new high beyond this point. This supports the view that the bounce is not yet over. This is short-term bullish divergence. It's really not particularly strong though. The difference in the closing point for price is very small. We see it here at the daily chart level for Wednesday's session, new high from the AD line. Price has not managed to close to a corresponding new high. There is, at the daily chart level, mid-term bullish divergence, but as you can see, it really is very weak. Between price and Nasdaq, there is this extremely long-term bearish divergence. This is March 2009, the end of the global financial crisis, as the S&P 500 has embarked on this very long-term bull market. Nasdaq has been making new lows with its AD line. This upward movement does not come with corresponding new highs from the Nasdaq AD line. As price is moving lower, Nasdaq is making strong long-term new lows. It hasn't been helpful in timing a huge bear market. It happened here and it happened here, and yet the bear markets the S&P embarked on were relatively shallow considering what you would expect from how bad this looks. I think this is probably going to develop further as the secular bull market comes to an end for Grand Super Cycle Wave 1 to finally find its end. For the short term, there's a little bit of bullish divergence this week. Price has not managed to close to a new high beyond this prior point, whereas the Nasdaq AD line has made slightly a new high beyond the corresponding point. This divergence is bullish, it is relatively short term, and it is weak. It supports the view that the bounce for the S&P is not quite over yet. But it's not strong enough to tell us that a new bull market may be underway. Between price and inverted VIX, there's over 4.5 years of bearish divergence at highs. Inverted VIX for 4.5 years failed to make corresponding highs. That's obviously not particularly helpful in timing and probably will develop further if the bull market does indeed continue as this analysis expects. For the short term, price has not closed to a new high. Inverted VIX has made a new high. This divergence is bullish. It's a little bit stronger with inverted VIX, supporting the view that this bounce is probably not quite over. If price can also make a new high on a closing basis, then that divergence would be resolved and it would no longer be indicating further upward movement or bullishness for price. For the very short term this week, volatility of VIX has increased, whereas VIX has declined. With volatility of VIX increasing this week, this is bearish for price for the short term. For the very short term, we see that mid-term divergence between price and inverted VIX. It's bullish. For the very short term on Friday, volatility of VIX showed an increase. VIX declined. This very short term is bearish for price, and I won't give it weight. It's too short term. That's all for me with your S&P analysis this week. I hope that wasn't too much, too confusing. I hope it made sense. Please ask any questions that you have in comments below this post. And I hope everyone has an awesome weekend.